Good morning, everyone. Today, we'll delve into a crucial topic and in-depth analysis of gold ETFs, focusing on their structural differences and the concept of mathematical decay. Our report will provide both quantitative and qualitative insights into this fascinating and complex area. To begin, let's define mathematical decay. This refers to the erosion of value in a financial product that is caused by its underlying structure or an operational reset, completely independent of the asset's market price. We'll explore two primary forms of this decay. First, rollover costs. These are losses incurred in contango futures markets when you sell expiring contracts only to buy more expensive future contracts. Second, volatility drag, a compounding effect predominantly seen in leveraged products, where daily resets progressively erode value, especially during periods of high volatility in the market. Now, let's move to Chapter 1, where we will examine ETFs that exhibit no mathematical decay. Our focus here will be on physically backed ETFs. Starting with the US market, here are some of the leading physically backed gold ETFs. We have GLD, the SPDR Gold Shares, with an expense ratio of 0.40%, storing its gold in London. IAU, the iShares Gold Trust, at 0.25%, uses multiple custodians through JP Morgan. For those seeking lower costs, GLDM, the SPDR Gold Mini Shares, offers a 0.10% expense ratio, also storing in London. Similarly, IAUM, the iShares Gold Micro Trust, comes in at an even lower 0.09%, with its holdings in London. It's crucial to understand that these ETFs hold 100% physical gold bullion, meaning they have no structural decay over time. Continuing with the US market, other notable physically backed ETFs include SGOL, the ABRDN Physical Gold Shares, with a 0.17% expense ratio and storage in Switzerland. AAAU, the GS Physical Gold, at 0.18%, stores its gold in London. And BAR, the Granite Shares Gold Trust, also at 0.17%, with storage in London. These products are known for their highly reliable tracking of spot prices, achieved through regular audits and transparent vault operations, ensuring investors that their holdings accurately reflect the underlying physical asset. In the Japanese market, we also have key physical ETFs worth noting. First, 1540 the Physical Gold ETF, with an expense ratio of 0.40%. This ETF uniquely stores its gold in Japan with Mitsubishi UFJ, and it's the only Japanese ETF that allows for the exchange of shares for physical gold bullion bars. Next, 1672 WisdomTree Gold, with an expense ratio of 0.39%. Its gold is stored in London with HSBC, and it provides a cost-efficient way to track LBMA gold spot prices. Both offer direct exposure to physical gold without the complexities of other structures. It's important to distinguish between operating costs and structural decay. Expense ratios, such as those we just discussed, are simply linear subtractions for service fees and do not involve path dependency. For physical ETFs, these are highly predictable, representing a straightforward subtraction from returns. Furthermore, investing in physical ETFs offers more efficiency than directly buying gold coins or bars, primarily due to factors like spreads, taxes, and the inherent risks of theft. Therefore, our conclusion is clear: physical ETFs are the most efficient vehicle for gaining long-term gold exposure. Moving into Chapter 2, we will now explore ETFs that are indeed subject to mathematical decay, specifically focusing on non-leveraged futures-based ETFs. Let's look at what we call the contango trap and visualize its curve. Gold markets are typically in what's known as contango, where future prices are higher than the current spot price. This creates a structural rollover loss. Imagine selling an expiring contract at $2,000, then immediately buying a future contract at a higher price, say $2,010. This results in a $10 loss realized per contract, simply due to the market structure. This graph clearly illustrates how the contango curve, where future prices are above the current spot, leads to this inherent cost over time, unlike backwardation where future prices are lower. Here's a list of non-leveraged futures ETFs and their associated decay risks. For example, 1328 Next Funds Gold tracks futures contracts and faces constant roll costs. 1456 I for ETF Gold H not only incurs roll costs but also additional currency hedging costs. Interestingly, DGL Invesco DB Gold was liquidated in 2023 due to underperformance, a stark reminder of these structural issues. It's important to note that currency-hedged ETFs, like 1456, face an additional mathematical cost stemming from interest rate differentials, further impacting their returns. Now, we turn our attention to Chapter 3, where we will examine the significant danger of volatility drag, as it applies to leveraged gold ETFs. This slide illustrates how daily compounding can destroy value. The decay in leverage products can be approximated by this formula: decay is proportional to the square of the leverage factor, multiplied by the square of volatility. What this means is that decay scales exponentially with leverage. A 2x leverage fund, for instance, decays 4 times faster than a 1x fund. A 3x fund decays 9 times faster. This compounding effect, especially with high volatility, can significantly erode the principal over time. For reference, here are some leveraged and inverse gold ETFs, highlighting their mathematical characteristics. UGL, the ProShares Ultra Gold, offers 2x leverage but comes with significant volatility drag. DGP, the DB double long ETN, also 2x leverage, combines roll costs with compounding decay. GLL, the ultra-short gold, is a -2x inverse product, designed as a bearish tool, but experiences rapid decay, making it unsuitable for long-term holding. Lastly, GDXU, a gold miners 3x ETF, offers 3x leverage on mining stocks, leading to extreme erosion due to the combined volatility of both the underlying assets and the leverage. It's critical to understand that these are highly speculative tools, generally not suitable for holding periods exceeding a few days. Let's compare the total cost of ownership across these different investment types. For physical gold ETFs, expense ratios range from 0.09% to 0.40%, with no roll decay and no compounding decay, making them suitable for recommended holding periods of years or more. Futures-based 1x ETFs have higher expense ratios, from 0.50% to 0.80%, and crucially, they incur present roll decay, but no compounding decay. Their recommended holding period is typically months. Finally, leverage ETFs have the highest expense ratios, 0.95% or higher, with roll decay that is effectively doubled due to leverage and extreme compounding decay. These are only recommended for very short holding periods, usually 1 to 2 days, highlighting their speculative nature. This chart projects the 10-year theoretical asset value under specific assumptions: a spot price increase of 10% per year, a contango of 1% per year, and a volatility of 20%. As you can see, a physical gold investment is projected to reach 2.5 times its principal. However, a futures-based investment, even under these favorable conditions, only reaches 2.2 times its principal. This stark difference demonstrates how, over time, structural decay creates an exponential gap in returns, significantly eroding the potential gains for futures and especially leveraged products. In conclusion, our strategic investment guidance is clear. For long-term wealth preservation and inflation hedging, physically backed ETFs are unequivocally the only rational choice. We recommend options like GLDM or IAUM in the US market, or 1540 and 1672 in Japan. For short-term tactical speculation, futures-based ETFs, such as 1328, or leveraged funds may be used, but only provided that investors fully understand that the mathematical odds are stacked against them in the long run. Thank you.